Welcome to the Money Mentors Podcast.
Well, I gotta say, I'm pleased that you're listening to my voice, but I want you to know I'm in sunny Barbados today. And we'll be there tomorrow. And I am bragging because I know it's like 30 degrees back home and all that, but it's 2.5 times more of that where we're at today. And I am going to say my bones are starting to melt.
Finally.
Well, we're doing a good favor to our clients back in Michigan. That way we can bring that sunshine back with us. We're trying to rescue everybody here from the depths of winter.
Yeah, I was told to bring an extra suitcase to pack that baby in.
Yes, please bring back the sunshine, the warmth for all of us. But what a good time to make a little getaway.
And I think that's really important for even our clients or those out there is that, you know, when you've got enough and you just said, hey, I've had it, it's time to go, whether it's your workplace or you're in retirement in the snow and you want to get out, you should be in a position that you can say, yep, it's time to make this happen.
Mm-hmm. And seeing a lot of good travel deals out there right now, too. So you can actually get some bargains while you're at it. I'm seeing a lot of cruises go on sale right now. So I don't know if the cruise industry is suffering or something, but here's your chance. Take advantage of it. Get out, get the sun, and get going. But we're here with your money mentors every weekend to get you thinking about those things that you want to do in your retirement years to give you that kind of financial freedom and flexibility to go on a trip when you want to see the grandkids when you want to do anything that you want to do with those years. But if you have questions for us today about how do you make that happen, feel free to reach out to our team off the air at any point during today's show at 800-536-8907. We'd love to hear what's on your dreams, goals, and desires list too. Or go online anytime. You can always start there too at mattsonfinancial.com. Meanwhile, here at home, we have a lot of financial headlines to talk about this week here, Gary and Taylor. So if you like big, round numbers, you probably like this. The Dow recently crossed the 50,000 milestone for the first time. And what surprised many analysts is just how quickly this happened after what really has been a volatile few weeks on Wall Street. Now, Henry Schwartz, who's with Derivatives Market Intelligence, tells Yahoo Finance, we tend to see these quick rebounds when the market dips these days.
Buy the dip really has become a reflex for a very, very large part of the trading population. And, you know, people that have been trading for 5, 6, 7 years, this is kind of all they know.
It's interesting. 5, 6, 7 years? No, you've been buying the dip now for decades. I mean, this is not a new concept for you, is it?
No, in fact, one of the things that we really, I think, distinguishes us against all other financial advisors out there is that we are true money managers. We don't just take money in and set it someplace and let somebody else look at it and do what they're going to do and try to get another client in the door. Our job is to take care of those dollars from day one to match up with whatever our clients' dreams, goals, and desires are. And we always like to say that we have a position that's outside of stocks and bonds so that whatever stocks or bonds are doing, we can come in and buy more. Look at it this way. If every time the market went down 10% or greater, you bought into it, what would your portfolio look like over years? I can tell you the vast majority of our clients do not take money out of principal. They take it out of gains. And they want to do that and have that income forever. And sometimes we have 5, 6 years of gains for income already made in the portfolio. So then we can take a little more risk and take a little more diversity and actually help the client grow their portfolio even more. In fact, just this last week, we had a client come in and he said, Gary, he says, I want you to know, when I came in here 3 years ago, you told me you're going to take care of me, and I was skeptical. And my wife said, no, let's give him a shot. He says, you grew our portfolio by $500,000 in that 3 years. And he says, you blew us away. So he said, wow. I'm bringing all the rest of our money here. We're very comfortable. You got us diversified. We're buying in it and drinking the Kool-Aid. And I'm going, yay, you know. But that's what we want. We want to prove ourselves to each and every client.
And I think that's pretty common. You know, we've got clients that we've had for well more than a decade, right? But those clients that have been clients within a year, 2, 3 years, if they've been through a tough market cycle like a 2022 or just some volatility like we've seen so far this year and in 2025, they start to get the feel for, okay, we understand the purpose of the money. We've got this money set up for our income bucket, so we know our income's taken care of. We've been harvesting gains, so we can employ those gains back into the market. It takes a little bit of time, but that's what happens with most folks is they see how the philosophy, not just in the first appointment when we're explaining the philosophy, but how that philosophy actually works once we're employing it and we're investing those dollars and we're in the markets. So it's very rewarding for us to see. But yeah, this isn't new news, something we've been doing for just a couple of years.
Yeah, in fact, Taylor does it, Gerald does it, I do it. So it's not individual advisor doing that. It's our firm financial philosophy that we put forth each and every day for our clients.
So for our listeners out there who'd like to get to know more about this investment philosophy, again, we're seeing, some of these market highs continue, but at the same time, you do see those dips every once in a while. But the biggest trick for investors is knowing when to get in, when to get out. So if they want to see how this works at Mattson Financial Services, how can they get started with us this weekend?
Yeah, and there's actually some great strategies too. If markets are at highs, that we can start harvesting some of those gains and protecting it so we can employ it later on. But for those who are interested and want to sit down with one of the fiduciary advisors here, give our office a call at 1-800-536-8907. If you've saved $250,000 or more for retirement, we'll be happy to sit down with you and create that customized Mattson map for you.
And just as the client, Gary, mentioned, had to go through a couple of market cycles to see how this works and, see how their portfolio grew. A lot of times, that's the case. A lot of people understand the difference when you see how it works for yourself. But if you want to come in and start building that plan on paper at Mattson Financial, reach out to our team off the air at any point during today's show. Again, that's 800-536-8907. Or you can always start online too at mattsonfinancial.com.
And that's the thing I really want to share with those that are listening out there, because you might say, well, my portfolio is really high right now, I don't want to bring it in. Or when the market's really, really down, I don't want to move my portfolio now because the market's down. Mm-hmm. Understand this, when the market's high, when the market's low, whatever the market's doing, there's always an opportunity within the market. That's what we bring to the table. So when's the best time to come to us? Now. When you're thinking about it, now's the best time. Let us look at where you're at. We'll put together the plan like Taylor said, and we'll make sure that you're informed to see the difference of what your money in retirement can really do for you.
So again, talk to our team off the air today if you want to get started. 800-536-8907. Best time is now, though. Or go online to mattsonfinancial.com and get started there this weekend. Well, guys, the Great Wealth Transfer, as they call it, is underway now. Economists are predicting nearly $73 trillion, maybe even more, based on the market, will change hands among family members in the next 2 decades. So what issues do you see potentially cropping up tax-wise as this transfer from generations takes place?
Yeah, I think I want to focus on the area of more so kind of the everyday people. So you're putting money into your 401k, your IRAs, all throughout your working years. You retire and you've acquired a nice nest egg that's continued to grow. It's been a blessing for you and your family throughout those years to have that retirement lifestyle and income that you need. But then you pass on. And let's say we leave, just for easy math here, let's say we leave $2 million behind and it's all in your 401k. And you've got 2 children. And you're splitting that up evenly between those 2 children. Well, there's been changes to how that money can be spent, or when it should be spent, rather, coming from those 401ks and IRAs. You've got a 10-year period that you've got to pull that money out if you're a non-spouse beneficiary. So if you've got 2 kids, they both inherit $1 million. It's a huge blessing, but now they've got to liquidate that $1 million over a 10-year period. And typically this happens when they're in their higher earning income years, right? So they're already up a tax bracket, and now we're forcing some of that money out of the 401k to them that they may or may not need. They can always reinvest it, but it doesn't change the fact that there's going to be a big tax bite there. And so that's why we've focused and specialized so much on tax planning here at Mattson Financial. So when our clients do want to pass on that legacy and estate, we can do it as much non-taxable as possible. So that's one thing that I see is big 401ks, big IRAs, forcing taxable events.
And if you look at historically, we've seen in the 80s where we had, like Taylor said, $1 million portfolio with between estate taxes and income taxes, it erode 60% of that. Right now we have things in place that we won't see that in the next few years. But I can tell you now that taxes are going to go up. In fact, in 1944, the highest tax rate was 94%.
Wow.
Of course, we had World War going on. But again, what economic pressures are the United States going to have with the debt we've got that we won't see that ever again? No, it's already a precedent out there. So once again, you want to look at it from the standpoint, like Taylor said, is that going to be a huge tax move? And are you going to participate in making sure they're going to pass on the wealth to your kids, or are you going to pass the wealth on to the IRS?
I think we'd take the kids all day, right?
I would.
Yeah.
Even if they're brats, I'd rather have them have it.
Or
you know?
charities. Right?
Yeah.
Like,
Yeah, the government plan is not our plan here at Mattson Financial Services. So this is a really important conversation. Again, a lot of you've done the right things. You've saved all these years. You worked really hard for it. Keep it in the family, or as Taylor mentioned, give it to your favorite charities. But let's have the control over that rather than giving the government control over what happens to your dollars. But if you need some help with that too, feel free to reach out to your money mentors at Mattson Financial Services. They talk about all of these different issues in those very first meetings. You can do that off the air today at 800-536-8907. Or remember, we have a lot of great resources too on our new revamped website at mattsonfinancial.com. That's Mattson with 2 T's financial.com. But coming up, are there still some things you can do to reduce your tax bill for last year? We'll find out if we can go back in time a little bit here with Gary and Taylor as Money Mentors continues on Wood Radio.
Want weekly lessons from your money mentors? Yes. Hit the subscribe button now and listen every weekend on Wood Radio.
We always appreciate you joining us here on Money Mentors every weekend and talking through things with Gary and Taylor this week, your money mentors at Mattson Financial Services. And it's not just the season of love, it is tax season too. We've been focusing on this a lot lately here on the show. But it's interesting, guys. While we're working on our 2025 tax returns, looking back, Yahoo Finance points out there are still a few ways for us to save on taxes in retirement. Some even apply to this last tax year. So let's talk about these this week because we do still have a little bit of time before April 15th. So what are some of those moves we can make right now?
Yeah, and this is what really, again, makes Mattson Financial Services different is that everybody has an opportunity to lower their taxes. We always talk about control. Control what you can control. You know, the market goes up, the market goes down. We can't control that. We can control how we respond to that. And one of the things I'd like to talk about is when we talk about clients is that maybe we save you 2% in taxes, maybe we save you 1% in advisor fee, and maybe we get you a 2% better return on your portfolio. Well, that's a 5% difference overall than you're doing now on a $500,000 portfolio. That's an extra $25,000.
Wow.
So Taylor, take it away and show them how we save them money in taxes.
Yeah, number one's a pretty easy one, the IRA contribution, right? If we owe a little bit of money to the IRS when we're going to file our taxes, why not look at potentially making an IRA contribution to lower that taxable income? If you're going to spend that money to the IRS, I'd rather see you put it into an investment account in your name. We can worry about the tax planning on the rest of that later. But the easiest one, of course, the low-hanging fruit is IRA contribution.
And make sure that you look at it from the standpoint, maybe you're a stay-at-home mom or a stay-at-home dad, and the other person's out there making the money because you're contributing to the family in a different way. Great. But remember, you can have a spousal IRA, meaning that your spouse can take income, put it into your IRA, and you still get that tax deduction. And that's good for two reasons. One is that, again, save on taxes, but secondly, to diversify your portfolio, maybe on payouts that require minimum distributions because there's an age difference. So once again, having spousal contributions is important as well.
Good to know there. Now, let's talk about HSAs too, because I know you've talked about the tax-free advantages there, actually triple tax benefits with this one, right?
Yeah, absolutely. You know, you get compound growth on your initial investment that you put into the HSA on the taxes you would have otherwise paid. And so with that HSA, you can use that to then obviously pay for those medical bills. If you know that you're going to have upcoming medical bills, we all do, right?
Yeah.
If you're eligible to make that contribution to the HSA, why not do it? You can always reimburse yourself from prior years too if you need to get that money back out, but you can still make that deduction, and that will definitely help out and go a long way with taxes. And also, planning for your future too. If you're going to be one of those people that wants to retire prior to 65, having a good HSA balance isn't a bad tactic to help pay for some of that additional medical costs. So you don't have to look at it as just a today contribution that's going to affect our taxes today. It is going to help you in the long run as well.
And it's a great extra bucket to have extra funds. If you've done well with a Roth IRA, you've done your regular IRA, 401k, this is an extra bucket out there. You can put money, and like Taylor said, it grows, but you get to choose when you use it. And there's a plethora of things they can use against it. So it's not just a medical bill. It could be transportation, driving into and from the doctor for those miles you use. I mean, it's got a lot of other things. I don't know about you, Taylor, because you're so young, but I take over-the-counter stuff like aspirin and some other things that they tell me is good. Laura put me on to say my joints are good, that type of stuff. They're all included in that deductibility for that account.
Very nice. In talking to my tax preparer, too, he said, some of the recent changes with the One Big Beautiful Act are really benefiting a lot of taxpayers, too, as they start to file their returns. One of the big ones is to look at your standard deduction. The math has changed on that quite a bit, too, right?
Yeah, absolutely. So for a married couple that's filing jointly, the standard deduction is now $31,500, which is about a $1,500 increase from last year. But if you're over the age 65, you may claim an additional $6,000 per person. So now if we total that up, that's $43,500 in a standard deduction. That's going to drastically reduce that income. And some folks might even be surprised and get a little bit of a refund this year.
Nice.
But the big thing to remember about this is that on that $6,000 per person, that's a phased in, and it's going to be phased out in 2028. So you really want to make sure, whoever your tax person is, that you're taking that extra and making sure you utilize that, because it's going to go away.
Yep, and it does phase out based on income. So it's a good thing that you brought that up. It is phased out based on your income level for the year. So again, That's something your tax preparer or accountant should be looking at. But I mean, it's an additional $12,000 if you're over age 65. So.
Yeah, you might even want to say, hey, I'm not going to do standard deduction because by doing the charitable contributions and maybe I've got some medical expenses, these things can lower it so you can be using that extra $6,000. So you really want to look at your tax math.
Yeah, for sure. Run some of those numbers. Good point there, Gary. Next thing that Yahoo Finance mentions here is state and local tax breaks. Do you see a lot of that here in West Michigan for people, things like property tax breaks, that kind of thing, if you're a little bit older?
Not really. There's some areas that it does happen. A gentleman came in and he was in the military, and so he has a income coming in that he doesn't pay taxes on, but it's very few overall. But there are things that we can utilize to make sure you're taking advantage of those adult tax breaks. Give an example: if you're taking care of your mom or dad and you're paying for that, as long as you're contributing 61% or more of their housing and food, they can become a tax deduction for you. And so you got to look at from the standpoint, what's the best way to do that? So like my mom, I mean, she had cost of in care of $14,000 a month. Now, we got a break because it was so expensive, and it was a table that we used that Medicare actually has a waiver out there. So we got a credit of $36,000 for her care because of the Medicare waiver. So once again, there's things out there, tax breaks you can utilize. So you really want to ask all the questions, give all the answers of where you're spending your money and what your costs are.
And then finally, Yahoo Finance mentions, this is not for last year, but while you're doing your taxes for the past year and you have some of those documents out, it's a really good time to start strategizing and get a leg up on next year's return.
Yeah, right around tax time or shortly after tax time is a great time for us to have a review, whether you're a new client to us or a current client. I run a lot of reviews this time of year because it's all right. The taxes are fresh. We've got them, especially now that we've got Maggie here in office. We've got access to those. And so it's a really good time for us to sit down, look at everything. Okay, what could we do better for next year? What changes in your life are coming up? So what changes do we need to make in the portfolio or contributions? What do we need to look at to help save some money in taxes next year? Maybe looking at Roth conversions, or maybe we should contribute a little bit more via a qualified charitable distribution next year so we can give some more of that money to charity and not to the IRS. It's just a really important time, and it's easier to do when it's top of mind. You just got them done. They're hot off the press. Let's sit down, take a peek at them and see, okay, how can we structure this, take advantage of years to come?
Yeah, that's one of the things that we see most retirees miss is the tax opportunity-wise in choosing the right way to make a charitable donation. People think, well, I'm giving tithes to the church, and they think that they're going to do it continuing like they've always done it, right out of their checking account or cash that they put it into the plate there when they're at church. You can give money out of your IRA directly to the church and get that qualified charitable distribution if you're 70 and a half or older, and then actually utilize it so you're paying less taxes and giving more money.
I've had that conversation a ton of times with folks. It's like, well, do you tithe to the church? Yeah, and we give to these couple of charities, they're near and dear to us. And it's like, okay, well, why don't we look to start doing these QCDs, right? It just makes sense. Why would you take taxable money to then give to the charity, not get some sort of tax deduction for it, which I know is not the point. But if we can save money on taxes, we absolutely should. I'd rather see more of that hard-earned money stay in your portfolio and be able to live on beyond you and go to the charities that you want.
And that's just being a good steward. I mean, if we not have to pay taxes and give to the charity, that's being good stewardship.
So many good steps mentioned here in this article, but for our listeners who haven't talked taxes with their advisor, maybe they've been solely focused on investment returns, how can they get started with us at Mattson Financial this weekend?
Yeah, be one of the first 5 callers. If you've saved $250,000 or more for retirement, call us at 1-800-536-8907. We're going to look at the portfolio holistically. Of course, we're going to talk about taxes, your returns, but we're also going to talk about things like your estate, your legacy, the health insurance, Medicare, all of those things. Looking at this as a holistic approach, we're going to put it all together to you in a nice digestible packet and get you started on your Mattson map today.
And as fiduciaries, we're going to make sure it meets your dreams, your goals, and your desires.
And while you have those tax documents together, it's a great time to sit down for this conversation. Feel free to reach out to our team during the break here. Be one of those callers right now. That visit's complimentary for you to get started. 800-536-8907. 800-536-8907. Or you can always set up that phone call, too, through our website at mattsonfinancial.com. But next, are you a hidden millionaire? And if so, what challenges can be hiding in your financial plan? We'll talk about it next as Money Mentors continues after the news right here on Wood Radio.
You're listening to the Money Mentors Podcast.
Here's really an interesting stat for a lot of our listeners out there. You might be among a group of investors known as hidden millionaires. USA Today reports savers are quietly passing the $1 million mark each and every day in their retirement accounts. Yet there are 6 common mistakes among these hidden millionaires that they tend to make, even though they've been really, really good savers. So I thought we'd talk about these this week here, guys, because I have a feeling a lot of us are probably making some of these mistakes. Now, number 1 on their list is one we have talked about here on the show, but it's so easy to make this mistake within your portfolio, and that's something called cash drag. What do you mean by that?
So cash drag is when you roll over a 401k and that cash gets transferred into your IRA and then sits and sits and sits and doesn't get reinvested back into the market, right? And this is going to be more common if you're doing this on your own potentially, right? You roll the 401k over, I'll get logged into that Schwab or Fidelity account, get that invested, and then it sits for a couple weeks and we see a good, even a 2 or 3% run in the market on $1 million. Like that's still a pretty sizable amount of monthly income that you missed out on just by not being invested. When we roll those funds over here, obviously, essentially the day that they get rolled over is when that money's going to be invested. That's one that if you're not careful about and you don't pay special attention to, it just happens.
And it can happen in a mutual fund where they're doing like dividend payments and those type of things. It's not being reinvested. So you really want to look at that and make sure that the cash position is intentional.
Yeah. Keep that money working for you. It's what we always say. Next mistake that a lot of these hidden millionaires make is stock concentration, having too much in one particular area. Do you see that a lot?
I have.
Unfortunately.
Yeah, I can think of 2 instances specifically, right? And they just happen to be the companies that they work for, right? Think of local places here in town or like a Sherwin-Williams. Everything in your 401k is going into it. Then you get stock options and you're buying the stock outside of the 401k plan. Next thing you know, you got a couple $1 million in one individual stock. That can be very bad. Fortunately for the folks that have become clients that had that issue, it was a good stock and it did well for a long time, but when's that shoe going to drop? Are we going to see a big correction in one particular stock? Amazon, for example, is a very volatile one, right? And so if you've got the majority of your nest egg in that one particular stock and it goes down 10, 15% because of a bad earnings report, that's huge to your overall nest egg. So again, diversification is key, but diversification with that purpose. What is this money for? Is this for your income bucket? Is this for long-term growth? And so that's what we're going to sit down and look at and make sure that we don't have too much concentration in one particular area.
And it can be a gift that keeps on giving that hurts you. Let me explain that, is that we've had people that receive a gift from their family members. They passed on and they says, okay, I've got this stock. Whatever you do, don't sell this because this has always done well. And it has for many, many years. But we have a client that came to us and says, I don't know what to do. My dad said, whatever you do, don't sell this stock. And I just don't know if that's the right advice because I see a lot of things in the news and I'm just not sure what to do. Well, the stock was held 100% natural gas. And as we know, natural gas goes up, it goes down, it fluctuates. And while he was getting a nice dividend at that point in time, the company actually was bought. And so they cut out the dividend because they're going to go into research and development. And so that dividend wasn't there anymore. So the reason that he told them never to get rid of it wasn't valid anymore. So once again, we looked at it, diversified the portfolio. So yes, stock concentration can happen by gifting. It can be happening like, hey, I'm going to buy the S&P 500 from Fidelity, and I'm going to go to another mutual fund and buy a different S&P 500, so I'm diversified. No, you're not. In fact, a lot of portfolios own the big seven out there. And so you got to make sure that when you're looking at different mutual funds and investing, you're not over-concentrated in those stocks as well.
Interesting stuff here. So if you want a second opinion on your portfolio, we're going to tell you more in just minutes here about how you can sit down and evaluate your investments with your money mentors at Mattson Financial Services. But another big mistake that a lot of these hidden millionaires tend to make, according to USA Today, bad debt management.
Well, what happens, we get so concentrated on building up this fund that we got cash there and it's sitting there and it's, oh, look at this. I've got 50,000. Now it's 55. And now I got 75,000 here. And I don't want to move that because I'm watching that build. But we're losing on the back end because, again, it's getting maybe 2 or 3%. And we're carrying the debt out there because of high interest rates that we should have got rid of. In fact, we had a client do this. He actually went out and bought his house, did all that type of thing. And then to build his garage, he went out in the secondary market and actually built the garage for $20,000, but he was paying almost 18% in interest thinking he was going to pay it off. He had almost $75,000 in his account making 3%. And again, he's paying that extra dollars or high interest rate on that $20,000. I said, let's just clean this up. Oh, but I don't want to give up my cash position. Well, that's foolishness. Let's get rid of the bad debt and either refinance it to something that's better, which we couldn't do at that time because he had too much exposure on the house. So again, we used that cash, lowered that down, and the money we saved in those interest rates, he kept putting back into his cash fund. So we can get there, but you have to look at it a little differently sometimes.
Good point there. Next on this list here, some of the mistakes that we tend to make even among good savers is poor estate planning. I mean, how many times do people forget about this step?
Maybe not as much forget about it, but just think that it doesn't pertain to them. This is for the ultra wealthy, right? That's not necessarily the case. I mean, we need to make sure that as a part of your estate plan, you have your power of attorneys, your healthcare patient advocates, the deed to the house is all set up the way it should be. It's just checking those boxes to make sure that everything is taken care of. It doesn't mean you need an elaborate $20,000 estate plan, but I think we need to make sure that we're looking at it. How can it help protect us? And if we don't have that, how much is it going to cost your portfolio and your heirs after you're gone for probate costs, attorney fees, taxes, you name it? So this could be a really big savings in general if we plan accordingly ahead of that time.
Next on this list of common financial mistakes, too, is just simply poor financial planning. They mentioned that a lot of these hidden millionaires don't work with a financial advisor. Maybe they've just, kind of put off getting help in that arena, too.
Yeah, I think the big one here is, Gary mentioned in an earlier segment, is we're going to look and deep dive into the entire plan, right? Where can we save you money in taxes? Where can we maybe get some better returns than what you're currently getting or better cash flow? And what about fees? Can we save you some money in fees? Are we paying some front-end commission charges right now that we don't need to do anymore by reallocating the portfolio and getting out of those mutual funds? And so just that alone, like Gary had mentioned, if that saves you 5% overall, and that's an annual change on $500,000, that's $25,000. On $1 million, it's $50,000. That's a lot of money that's justifying that fee to sit down with an advisor to make sure that everything is taken care of outside of just the growth of the portfolio. That's just one aspect of this.
And it's kind of interesting that there was a study done, and I don't recall the exact percentage, but it was a high over 75%, that if they had a financial advisor, 78%, I think, was going to actually not run out of money. They were going to have a position that their portfolio and everything was going to perform, and tax-wise, exactly how they needed it to do for their dreams, goals, and desires. Then you add into it, we found out, like a financial advisor and your CPA or tax preparer, and then you add into your attorney, it's like a 300% will get through that to make sure they're going to have the retirement they want. So as you add layers of professionalism to your portfolio, you have greater success, not in just returns like Taylor was talking about, but success in passing those assets to whom you want, when you want, and how you want.
And you have access to all of those different kinds of resources there at Mattson Financial Services. And finally, I want to get to this last mistake that these really good savers tend to make, and that is unnecessary frugality in retirement, that fear to spend. We talk about this a lot because it's real.
Oh, this is the one that always, the ones that save very, very well, is the hardest to get over that hump to say, now it's distribution time. Mm-hmm. And I love the clients I'm going to share with you, but you can kind of see how this works, is that they were going to go to Florida because the market was good. We had the money set aside, so they have those dollars to go down to Florida. And so we got them back after Florida, and in May, when we're reviewing the portfolio, and I said, okay, how was Florida? And she says, we didn't go. I go, what do you mean didn't go? Well, the market went down when we were supposed to go, and he was worried that we wouldn't have money because the market would go down. And she said, I know it came back up and everything's fine, but it's new for us, and he just didn't feel comfortable. And I looked at him, I said, we had that $19,000 set aside. It was not going to affect the market at all. And she pokes him and says, see, I told you we should have called Gary. And, of course, what happened that fall was maybe this had something to do with it. They built a new pole barn for about $20,000. So maybe there were some other things going on. But, once again, they had the money. It did not affect them. We had it set aside. And that's what we love about what we do, is that your dreams, your goals, your desires are set up. And we have the money dedicated for that. So you're not in jeopardy to live the lifestyle that you want to.
Yeah, and that's what's so rewarding about our job is we get to see retirement through the lens of so many different folks. And we also get to give a lot of people ideas. Some people, maybe didn't travel a lot or have a ton of hobbies, and help them realize and find those hobbies and the things that they really enjoy in retirement. But sometimes we do have to give the permission to spend. I've had this conversation numerous times where it's like, okay, what are we going to do this year? What trips are we going to go on? How much do we need this? How much do we need for that? That way we can start planning for this thing so you guys can really, truly enjoy the retirement. You've saved this money for so long and you've worked so hard to do it. It's time to enjoy that. And we're here to give that permission to say, yeah, go enjoy that trip to Florida. Go build the pole barn.
Yeah.
Both of it, right? Or both of them.
And put a nice car in there, by the way. An antique would be all right. Classic.
Yeah, Gary will help you spend that money, do a little dreaming there with what you save for retirement. But that's what we want for our listeners. You worked really hard. A lot of these hidden millionaires, again, they're not flashy, but this is their chance to actually live the kind of retirement they want. But it does go back to that financial plan and getting help with that sometimes. So for our listeners who maybe are reaching some of those milestones with their savings and they want to learn more, how can they get started?
Yeah, give our office a call at 1-800-536-8907. If you save $250,000 or more for retirement, give us a call. Let's go through this plan with you. We're going to talk about the 5 pillars of retirement. Make sure you walk out of here with a better understanding of where you're at, where you're going to go, and how we're going to help you guys get there.
Yeah, that number again is 800-536-8907, or you can go online at Mattson Financial, with 2 T's, mattsonfinancial.com.
But up next, the disturbing labor trend that's underway in 2026. And what if you're forced to retire ahead of schedule? We'll talk about it next as Money Mentors continues on Wood Radio.
Getting you not just to, but through retirement. This is the Money Mentors Podcast.
Thank you so much for joining us this weekend. Gary Mattson and Taylor Stewart over there. You can get to know your entire team at Mattson Financial Services in a couple of different ways. You can always visit our website. We have so many great retirement resources on there too, but you can also learn more about our team, our investment philosophy, all those things you hear about on the show at mattsonfinancial.com. You can check out our podcast too, wherever you get your favorite podcast. And of course, you can talk to our team off the air too if you have a question about anything we discuss on the show at 800-536-8907. And each week here with your Money Mentors, we talk about different issues and the headlines, what's happening that could impact you and your life. And it's interesting, guys, the number of job cuts so far in this new year are the most since 2009. A lot of our listeners, I know, lived through that time, but we were younger during the last economic downturn. So it's another thing when you're close to or already in retirement, when you see, the economy start to do a little bit of these things,
for checking out the
kind of
Money
wobble
Mentors
a bit. So
podcast.
what do you say to someone who's worried about where we might be headed with this labor market?
Well, the first off we wanted to do is look at where you at, what's going on with your portfolio, where you at in the job market. Maybe you're in the position to say, if I got laid off, I've got enough money in my 401k that I don't need to contribute anymore, so I can go find a job that's less stress or more enjoyable in a different industry even, so I would enjoy it. So first off, we want to find out where you're at. And so if that happens to you, you don't have to worry. The second part of this is all actually what we call a changeover. It's not necessarily bad, but we're going to see some things moving around. We're seeing a lot of cut in the federal industry out there from U.S. jobs and those type of things from the federal point of view, but those people are being picked up very rapidly out into the regular private sector. If you looked at it, yes, we have some slowdowns, but so far the market's absorbed what we have because we actually are short people that are qualified for certain jobs. So we're going to see some of that softening, but I don't think it's going to be really something to worry about tremendously in the long term of what the market's going to do.
Yeah, I think that's where we got to take an individualized approach on this too, is market-wide or labor market-wide. What Gary said, I totally agree with. It's just, if you are one of those people, though, again, back to Gary's point, it's so important to have that sit-down meeting and figure out where are you at, even if that day hasn't come yet, but you can kind of see the writing on the wall. You're just getting nervous. There's some other big shifts going on at the workplace that make you feel a little uneasy. Well, then it's probably time to sit down and see where you stack up. And if you were to get tapped on the shoulder, so to speak, one day and you're not coming back to work, what's that going to look like for you? And get planning on that.
And remember that when markets change, there's opportunity. And that's why we don't predict what the market does. We react to it. So if a segment goes down and it looks like something that's going to be temporary and we can get into it, we're going to move your money or a portion of that into that because we're going to take those gains, buy in low, and guess what happens? When it comes back, then we do the same thing. It doesn't matter what the market's doing, there's always opportunity. Like when we saw, even in COVID, we saw the market go down almost 50%. I think it was 40 some odd percent that the market went down. We sold real estate, we sold precious metals, we got into it and we sold and we bought in that downturn, and it came up within 12 months that we knew it would because historically pandemics have come back within 12 months or less. So we knew what was going to happen. So let's participate in the best avenues we can, whatever is going on in the market.
Again, it's worth paying attention to. And we seem to be in one of those periods right now where, again, there might be a lot of opportunities with what's happening out there in the labor market. So something to keep an eye on here. But it's interesting. This kind of leads into our next story here this week. BlackRock CEO Larry Fink, he raised a lot of eyebrows in an interview with Bloomberg a couple of years ago when he suggested that we rethink the whole idea of retiring around the age of 65.
The other question is, should we reevaluate how we work and how long we work? Because we all need purpose in life. Most people find purpose, obviously, maybe with their grandchildren, their children, their community. Many people find purpose in their jobs. Mm-hmm. And the thought of retiring at 60 with 30 more years in front of you, we need to have a dialogue. We need to have a conversation.
I think he has a good point there. It's fine, if you want to work to have a purpose a little bit later in life, as he suggests. But there's one top labor economist who really disagrees with this and points out that most people cannot or do not decide when they retire. That decision is actually made for them because of something like a job loss, health issues, family issues, that kind of thing. So is that accurate based on what you see with your own clients, that decision sometimes made for them?
Well, I'm going to go back a little bit of how we are who we are through our workplace. If anybody's seen Top Gun and Maverick, he says it to Iceman. He said that I'm not just a naval aviator. He says, I'm a fighter pilot. It's not what I do, it's what I am. And when you spend 30, 40 years in an industry, whether you're a great welder or you're a person at Postal Department or a financial advisor, whatever that is, you are that now. And you're used to that rhythm and people around you and that comfort. And when you take that away, that comfort has changed. So once again, you've got to look at when you're getting ready to retire, how you're going to refill that bucket of self-satisfaction and knowing that you're going to be okay, not just emotionally, but the things you're going to do with your time. So as we do that, that's what we discover with our clients. We want to know their dreams, their goals, their desires. What decisions are they going to do when they're not doing that job anymore? And it goes back to the same thing we talked about, taking money out and do that. So many times people will say out there that I'm not going to need that much in retirement because I'm not going to be driving every day or I'm not going to have a lunch out. But you're going to be enjoying retirement. And that's why it's so important that you have a plan together, whether it's forced on you for retirement or you're making that choice yourself. Generally, we find that two things happen. One is that emotionally, you're drained at work, they're making some changes, and that's it. It's time to go. My favorite is that we have a client that she said that she told her boss that, hey, I checked with my financial advisor. I'm great to go and retire anytime. Anytime I have 2 bad days in a row, I'm done. He says, well, if you have 1 bad day in a row, take the next day off. So
to get ahead of it.
Yeah, we want to keep
boss.
You here. Yeah. After about 2.5 years, she did say it's done. It's time. And she changed careers and did something that was more to her liking. That wasn't as much pressure. She wasn't giving up working, but she was changing her realm of people that she was going to enjoy. So once again, it can happen where you're having financial loss or emotional loss, family members taking care of each other, those type of things. It could be a downsize. It could be selling of the business, or it could be, hey, I had 2 bad days in a row. It's time.
Going back to this list, the second gentleman here says that you cannot decide to retire. That decision's made for them based on job loss, health issues, yada, yada. I think that's an interesting one. I'm sure that there are people out there that are definitely in that boat, right? And I've had that conversation with clients too, and it's not really a can I or can I not. It's more of a do I want to? What am I going to prioritize in my plan? Am I okay with paying a little bit more for health insurance for this next, 18-month period to get done prior to Medicare age because I'm ready to be done and I can't afford to do it, versus the opposite of that, which is I'm prioritizing my work. I still enjoy what I do. That 18 months isn't that big of a deal. I don't need to worry about spending that additional money on the health insurance. So I'm going to stay working. It's more so, what does that individual person want in putting that plan together? If you not ran the numbers and you don't know the cost of insurance, your tax bill, what you've saved, how that's going to provide you enough income in retirement, then you're missing the boat. You don't know when you can retire because you've not done the legwork to figure that out or let somebody do that legwork for you. And that's essentially what we're here to help all of our clients with and all of our radio listeners is let's run the numbers. Let's see where you're at and see, can you retire when you want to? Can you retire earlier than you want to? I've seen that quite a lot as well, right? I plan on retiring at 65. And then they come back and we do the meeting and go over all the income forecasts. It's like, well, do you want to go at 62? Well, I hadn't even considered it. Well, let's talk about it then, right? Sometimes it's that pleasant surprise that you can actually retire earlier than you thought, just because you just don't know what you don't know, right? You've been working in your job for the last 20, 30, 40 years, and you're not a retirement planner, so therefore there are things that you don't know, and that's what we're here to help with.
Absolutely. So why don't we open up that invitation to a few of our listeners this weekend? Because I know there are a lot of changes right now in the job market. There might be some of those moments for our listeners who just wonder, have I done enough to have the option to walk away when I want to? So how can they get started with us this weekend?
It's really easy. You can go to the website at mattsonfinancial.com. That's Mattson with 2 T's, or give our office a call at 1-800-536-8907. Our wonderful staff is standing by to take that call and talk about what's retirement going to look like for you. What do you want it to look like? Get you scheduled to sit down with one of our fiduciary advisors, either myself, Gary, Gerald, you name it. We're going to sit down and run those numbers and go over that plan for you. If you've saved $250,000 or more for retirement, be one of those first 5 callers.
Find out what your options are, and our team will be standing by for a few minutes after today's show. If you want to give us a call now, 800-536-8907, 800-536-8907, or whenever you get to wherever you're going this weekend, just remember our website. You can always sign up there to schedule a simple 15-minute phone call to get to know the team at mattsonfinancial.com. That's Mattson with 2 T's, financial.com. And of course, be sure to join us here again next weekend for more lessons right here with your Money Mentors.
And remember, retirement isn't the end, it's the beginning of what's next. At Mattson Financial, we help individuals and families write the next chapter with clarity and confidence, aligning your money with your dreams, your goals, and your legacy. Start your journey today at mattsonfinancial.com, and let's build your Mattson map together. Oh, they say my pina colada is ready. Gotta go.
Thank you so much, everyone, for listening. Have a great weekend.
Want weekly lessons from your money mentors? Yes. Hit the subscribe button now and listen every weekend on Wood Radio.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Fee-based financial planning and investment services are offered by Mattson Financial Services, LLC, an SEC-registered investment advisor. Insurance products and services offered through Lakeview Financial Group, LLC, Mattson Financial Services, LLC, and Lakeview Financial Group are affiliated. To find out if Mattson Financial Services is licensed in your state, please call 800-536-8907.